Have you ever wondered why investors seem to lose their cool when September rolls around? That simple question has opened the door to understanding a pattern that has puzzled markets and investors for nearly a century. But what does this all mean? Let's find out. The September effect. Historically, September is notorious for being the weakest month of the year for stocks. The S&P 500 averages a decline of around 0.7 to 1.2% during this month, making it the worst stretch on the calendar. Since 1950, fewer than half, which is about 44% of September, have added with gains, far fewer than any other month. This pattern has persisted across different decades, which makes it hard to dismiss as coincidence. Many traders actually plan around this trend, knowing that markets often stumble once September starts. Behavioral and seasonal triggers. At summer's end, investors and institutions often rebalance portfolios, cashing in gains, repositioning for year-end, or meeting fund redemptions. That rebalancing alone creates extra selling pressure that can weigh on the broader market. Seasonal psychology also plays a role. When investors expect September to bring weakness, they act defensively, selling more than usual. Over time, this turns into a self-fulfilling prophecy where nervousness itself drives prices lower. The mindset of September is bad ends up reinforcing the very pattern that people are worried about. Reduced buying, increased volatility. Late August and early September are also known for low trading volumes as many investors and fund managers are still on vacation. With fewer participants in the market, even small waves of selling can have a bigger impact than normal. This effect is often magnified after a strong summer rally when valuations are already stretched. With stocks priced for perfection, any bit of bad news can trigger sharp pullbacks. As a result, September tends to feel more volatile and unpredictable than other months. Amplification by macro risks. In 2025, the usual September weakness is being made worse by bigger issues. Trade tensions, tariff uncertainties, and political interference in Federal Reserve decisions have all added fuel to investor fears. Rising bond yields are making the problem worse, putting heavy pressure on high-growth sectors like technology. When yields climb, the future profits of growth stocks look less attractive compared to other safer options like bonds. This rotation into more defensive or stable assets leaves riskier parts of the market even more vulnerable in September. Companies like Nvidia, AMD, and Broadcom have been at the center of attention for the past 2 years because of their role in powering artificial intelligence. Investors rushed into these stocks, pushing the valuations to sky-high levels. But when the bond yields climbed and the fear of tariffs resurfaced, those same high-growth companies were the first one to get a hit. The problem isn't just about valuations. The semiconductor industry is heavily exposed to the global supply chains, meaning that tariffs or trade tensions can directly impact their cost and demand. So the news of potential tariffs on chips or other technology products totally rattled investors, leading to sharp declines in the sector. Not everyone sees the sell-off as a complete disaster. Some analysts, like those at UBS, argue that the dip in chip stocks is an opportunity. Their reasoning is simple. The demand for AI and advanced chips isn't going away, even if the market is temporarily down. Yet in the short run, big funds are rotating out of chip stocks to reduce risk, and that rotation is definitely putting more pressure on the sector. Artificial intelligence has been the hottest trade of the past 2 years. From cloud companies to semiconductor makers, everyone has benefited from the rush of money flowing into AI-related stocks. The excitement has been compared to the dot-com boom of the late 1990s, where investors piled into internet stocks with little regard for fundamentals. But with excitement comes concern. Some industry names like Sam Altman of OpenAI and investors like Ray Dalio have warned of an AI bubble forming. Their argument is that valuations are running far ahead of actual results. A recent MIT report showed that 95% of organizations who have been investing in generative AI have not yet seen meaningful returns. It means that a lot of companies may be overspending rather than reaping beneficial returns. And that is a classic example of a bubble. When we look at everything side by side, the story becomes clear. September is already a historically weak month. On top of that, chip stocks are facing pressure from high valuations, tariff fears, and rising bond yields. Meanwhile, AI trade, which lifted the markets for months, is now starting to show signs of exhaustion. In simple words, September's traditional seasonal weakness is being amplified by today's unique risks. And that combination explains why investors are feeling nervous and why volatility is spiking. The key is to stay balanced and diversified. Short-term pullbacks are definitely a part of market life, and September has always been one of those months where fear runs high. On the other side, long-term investors who stay calm, stick to their plans, and avoid emotional decisions, September is just another chapter in the broader journey of building wealth. With that being said, this brings us to the end of this video. I hope you found it helpful, and if you do, make sure to give it a big thumbs up and subscribe to my channel for more financial insights. Until next time, take care.